Three things that could threaten stocks and the financial markets. He's Matt Maley with Miller Tabak. Matt, welcome. What are the three things?
Well, there could be enough. I've highlighted three things, but there could always be anything that could really hit us right now, because we're kind of moving into this second wave of the bear market, and that's when these things. I've said, Warren Buffett has said in the past, it's when the tide goes out that we see who's been swimming naked, and that's what happens when the second wave of a bear market hits. A couple of things that I've thought that come up, it could be, what would cause some forced selling in not only in the crypto market, but also in the which in turn cause selling in the stock market. We also have this big issue of corporate debt. We have mountains of corporate debt, historic levels of corporate debt, and when you have the interest rates moving up the way they have been, and the way the Fed says that they're going to keep pushing them up, that's going to could create some problems there. And then finally, we have the situation in Europe, which, as Brian just talked about, hopefully will get better with this, the things, hopefully getting better there for Ukraine and Russia being pushed out. But the problem is, if that doesn't happen, they're looking at a recession and a deep recession. And, it's hard for us to think that we're going to avoid a further slowdown in economic growth if places like Europe and China are slowing down further.
What I find very interesting here is your focus on the rise in corporate debt. Let's dig in a little bit deeper and put some numbers on that, if you don't mind, because my impression was that compared with 2007-8, the great financial crisis, a lot of companies are less heavily levered than they were back then, particularly financial companies, but maybe it's only the financial companies that are less heavily levered.
That's it, Tyler. It's the financial companies are much less levered, but overall, corporate debt is now up to almost $11 trillion. That is an all-time record high. Same with global corporate debt. That's at all-time record highs, over 20. I think it's over 22 trillion now. So these are the type of numbers, and a lot of this debt, you got to wonder. Some of it has been long-term, so we won't have to roll it over soon. But a lot of these companies have debt that has to be rolled over in the next 2 years, and if that's coming out at higher interest rates, that's going to cost them more and have an impact on their earnings. And in some cases, especially for high yield companies, could have an impact on whether they'll be able to keep going as an entity or not.
Yet, in the face of all of these headwinds, Matt, stocks are extending last week's rally ahead of the August CPI report, which we get tomorrow, where we will learn if the Fed's anti-inflation campaign is starting to work. How should investors be positioned right now ahead of that key economic data point?
Well, it's like you said, CMA, it's such an important economic point, whether it should be or not, because it's always hard to know what's going to be coming forward. But it is going to be one that the market's going to pay very close attention to. The one thing that I do think that I have to warn people about a little bit is the Fed is not just fighting inflation right now. We have to remember they're fighting two things. They're trying to get interest rates and the level of their balance sheet back to what its natural level should be. Okay, it's not just the inflation issue. They pumped up, they took interest rates down to a ridiculous level because they pumped massive amounts of liquidity into the system. Now that has to come out. That means that we're not going to be able to keep with those kind of 22 times earnings. 2.4 times sales. The market's trading at 2.4 times sales. That's higher than it was at the top of the internet bubble when it was at 2.3 times sales. And so valuations have to come back down as the natural level. I guess my point is, as the natural level of interest rates moves up, the natural level of valuations is going to have to come down. And I think that's going to create some headwinds, further headwinds for the stock market.
So put a sharp point on it. Bring it home from third base here. You are saying that the rally we've seen in the last 5 days, 6 days is a mirage, and that you expect the market to turn lower quicker.
I do. I do. I think it's it was the market had become a little bit oversold, and the sentiment had turned quite negative. I'm sorry, quite negative. So almost not quite as bad as it was in June, but still pretty low. And that has created this kind of a short-term artificial bounce. If we get a good number tomorrow, and maybe it bounces a little bit more, but again, these valuation levels are too high, whether it be 18 times earnings on a PE ratio, price to book, 2.4 times sales, those have to come down. That's not the end of the world. It's going to be a normal and healthy process, but as Chairman Powell says, is going to be a painful one as well, I'm afraid.